All right, so let's look at Susan. So this is Susan's balance sheet from year to year. We're ending here December 31st, 2020, which is what we just saw. But if we look at her journey back several years, you'll see that she's been very disciplined about doing this. Now, what I'm recommending is that you do this on a monthly basis, right? So that you're checking in every month to see, okay, is my credit card balance increasing? Even if I'm making that, $100 payment towards that principal, towards that balance, maybe the interest is so high that I'm only, reducing that principal balance by teeny bits, but it's hard to tell because I'm not keeping track of it. So if we look at Susan's journey, we can see, for example, that she started off with $1,000 in her cash emergency savings account, and it has gotten up to 5,000. So, she's been steadily increasing that emergency fund. Her investment account has increased somewhat, but come down a little bit. Maybe it was a bad year for the market, or maybe she took something out to pay an expense at some point. Her retirement account is steadily increasing, and the value of her home is steadily increasing. So you kind of see the areas that are working well for her and maybe some areas where she might need to focus. Looking at her liabilities, her credit card balance is coming down. And if you were to adopt this strategy, I recommend that you list every credit card. If you have 4 or 5 credit cards that have balances, list them separately so that you can see how each credit card balance is increasing or decreasing, especially as you pay it off. We see how her student loans, she's steadily paying those off. She didn't have any debt to her mother. At some point, probably in 2019, she borrowed some and she's paying that down. Car loan and mortgage both steadily being paid down. So we can see how her net worth is growing over time. And what I would encourage you to do is to set a goal for your net worth growth. So, start today, track from month to month for maybe 3 or 4 months, start seeing some patterns, and set a goal for yourself. Do you want to increase your net worth by 10% a year? Maybe 15% a year? Pick something to start off that first year. I mean, depending on what your situation looks like, even 5 or 10% is a very achievable goal in most situations. And by doing that, you can identify different areas to improve. So do you want to increase your cash emergency fund, which would increase your net worth? Do you want to put more into your retirement account? Maybe take advantage of an employer match, which would increase your net worth. Of course, with your investments, you're also dependent on the market. So as you put money in, the market could go up, it could come down a little bit. So points in time, you might increase or decrease. But the goal of this exercise is to make steady progress over time. And by tracking that progress, you can actually measure the gains that you're making and adjust as needed along the way. Sorry, I'm moving this screen with everybody's video so I can see what's coming up next. All right, so again, this process shines a light on opportunities for growth. And there's 3 ways that you can increase your net worth, 3 main things to focus on. One is to decrease debt, of course, paying off your credit cards. You could reach a point where you decide to pay down your mortgage more aggressively. Increasing your savings, making sure you have a sufficient emergency fund. So if in case you have a loss of income or an emergency expense, you have a bucket of cash to go to. And increasing your investment return, taking advantage of the matches that might be offered to you or tax benefits of saving in a retirement account, for example, or adjusting the actual investments to increase your investment return, or maybe to make it more conservative and take less risk. Any thoughts or questions on this thought process before I go on?
I don't see anything in the chat box. I think we're okay there.
Okay. All right. So if you're going to set a goal for your net worth growth, Of course, the thing that's going to fuel that growth is your cash flow. We talk a lot about budgeting, so I'm not going to spend a lot of time on cash flow. But your money coming in, your income minus your money out is your cash flow. And if you're not intimately connected with the flow of your money, I do suggest tracking your income and especially your expenses on a monthly basis. So you know which categories are taking the bulk of your cash. Is it entertainment expenses? Is it travel expenses? Probably not this year, but normally. Where is your money going? Is it reasonable? And are there areas that you can free up some cash to meet those net worth goals? So money coming in, tracking from month to month, recording all of your various sources of income, and recording that at the end of the month, and then your money out. And so over time, you'll get a sense of your cash flow as well. And to be honest, after you do this for a while, maybe a year or two, if you're paying attention, you'll get enough of a sense of this cash flow that you don't necessarily have to, record every single category for the rest of your life. The point is to figure out, okay, how much do I need to save every month, or how much do I need to invest, or how much can I put into the next rental property, or how much free cash do I have to start paying down debt or reinvesting? All of those questions will be easier to answer when you get a good sense of that cash flow. So this is a way to become more intimately knowledgeable about your patterns and the patterns of your cash.
Hey, Vishali, is there,
Yeah.
do you have any recommendations? Like, are there apps out there to keep track of your net worth or your cash flow? Anything that you can recommend other than, I guess you could do like a spreadsheet?
Yeah,
But
so I'll be honest with you, I've been keeping a spreadsheet. I don't keep a spreadsheet of my cash flow anymore, but for about 10 years I did. When I started when I was about 22 until I was about 32. And I mean, every month, and back then, we didn't have like the apps and stuff, but Mint is a really good app and program, mint.com. It allows you to connect all of your financial accounts, so all your bank accounts, your credit accounts, your mortgage, everything. And you can create a budget in there so that you can track how much you're spending, and it'll tell you if you've gone over or under in any category. And then there's another app called, I think it's called Personal Capital, which I just discovered. And that does track your net worth and such like that. So similarly, you can connect all of your accounts and it'll bring all that information together. One thing I would say with Mint, the only thing I don't like about Mint is it's not easy to see historical data altogether. So like, for example, when we looked at Susan's net worth over the years, right? It's
right.
all in one report. Mint doesn't have a way to show you, how your net worth has changed over time in one report. So if you use an app like that, I would say at the end of each month, go into Mint and look at the, basically your values of all of your assets and liabilities and put it into a spreadsheet so that you have it. Both because it's not easy to run that report, but also because if for some reason you decide you want to stop using Mint, then you don't have that data, right?
Right.
So
Yeah, that makes sense. Thank you.
Great question. All right. So action items. Track your expenses, your income and your expenses. And if your cash flow is negative, figure out why is it negative? Look through your credit card statements and your bank account statements to see where it is. What are the things that you can change or stop spending money on and such. In one of my other presentations, I go more deeply into all these different categories. If you want me to, I can, but with our time limitation, I'm gonna move on unless someone has questions about specific recommendations. Okay. All right, so Those are a couple of strategies just to organize and make forward progress over time. So now I'm going to bring us back to 2020 and 2021 and talk a little bit about the strategies that you can start this year. Okay. So in terms of organizing your tax situation, always best to get organized for the year at the beginning of the year. I know many of us who work with CPAs or CPAs are reaching out at the end of December, beginning of January with a tax organizer, and they want all the receipts and the data. And it's like, oh my gosh, I've got to scramble and look back at all that stuff and gather all that data. And by the time you have it together, it's almost time. I mean, the tax deadline's looming upon us, then your CPA is scrambling to get your return done. If you organize throughout the year, you do two things for yourself. One is you're less likely to miss anything, right? You're less likely to miss that deduction that you can't find the receipt for, or it's buried in your credit card statement. You forgot that it was there, or the drive that you did from here to there, that's deductible. And anyway, you have a better picture, and you're taking advantage of all those deductions and benefits. Number two, your CPA will thank you. If you come to them in January or February with all your data neatly together and they're not spending time going through every single number and receipt, not only will they be able to prepare your tax return more efficiently and more accurately, but they'll be able to spend their time processing and thinking through tax strategies for you, rather than being so focused on those details. And I tell you this from experience because I spent time completing tax returns, and for clients who are very well organized, it was much easier for me to be thinking about the big picture as I was completing their return. So two reasons to start now for your 2021 tax return. Think through your strategy and talk to your CPA. We know the tax laws for 2021, so now's the time to think through which of those might benefit you this coming year so that you can be prepared to take advantage of them. All right, and create tax folders. So whether these are physical folders or if these are virtual folders in your Google Drive or your email, and maybe you have a combination of these strategies. So I have in my filing cabinet every year, I have a green hanging folder, and inside that hanging folder, I have little manila folders, and I label, W-2 income, healthcare expenses, for my rental properties. I have a folder for each of the rental properties. And as I go through the year, if I get physical receipts or physical statements, I put all those in there, in those folders, in the right category. Now that we have a lot of emailed receipts and, virtual data, also have a folder in my email that says tax and then whatever year, tax 2021, with subfolders, just like my physical folders. And so I can just save everything in those folders. Google Drive works for that, or your email system. And then establish monthly routines. So along with updating your monthly net worth statement at the end of the month, when you get that credit card statement or that bank statement, even if you're not reconciling everything, which I think you should do, but even if you're not, go through and highlight all those deductible expenses or anything that might affect your tax return. So if I get my January credit card statement, I'm going to go through and highlight, any doctor's appointments or prescriptions or, a meal that I had for business expenses or whatever, and just label that. And then I'm going to put that in my tax folder where I have a credit card folder, that's waiting every month for that new credit card statement. So if you can get into the habit of doing this once a month, it would take maybe an hour or two max if you do it all at once. And also remember throughout the month, as you're getting receipts, you're throwing them in your folders too. So your backup is there, right? Okay.
I'm impressed.
Right.
How much do you charge to organize all my stuff?
I can do it.
I'm sure you can, a lot better than I can.
Well, I can get you set up at least.
Yeah.
Get your processes
one other
going.
thing, I was thinking about a number 3. It would be cheaper for you to get your taxes done too if your CPA doesn't have to go through all your receipts and all that stuff.
That's very true. That's very true. A lot of tax preparers charge, per form, like, depending on how complicated your tax return is, but you'll reach a point, well, they're going to start adding in the time to, that
Right.
they're spending organizing you. So, okay, so some highlights from 2020 and 2021. I am not a CPA, so I have experience in tax, but you should talk with your personal CPA or whoever prepares your taxes to see which of these applies to you. A lot of, we can talk about these various categories, but there's so many nuances, income limits, and all kinds of other situations that might or might not make these apply. So, health savings account. I'm going to start with the health savings account because this is one of my favorite ways to save on tax and increase future returns. So if you have a high deductible healthcare plan, an HDHP, and you can ask your insurance company if you have, or if you're employed, your employer, your human resources department would be able to help you figure this out. If you have a high deductible healthcare plan, you can also open a health savings account, which is basically like a bank account or an investment account where you can deposit money, you can invest money for healthcare expenses. Okay, so the insurance plan is separate from the savings account, but you can't contribute to the savings account unless you have the high deductible plan. So they're separate but connected. The contribution limits for 2021 are $3,600 for the year if you're an individual, if you have an individual high deductible plan, and $7,200 if you have a family high deductible plan. So I'm going to explain how this works, and then if you have questions, please ask them. So basically, the year that you have the high deductible plan, you can contribute up to this amount into your health savings account. That savings account is yours. If you incur healthcare expenses and you want to reimburse yourself from the savings account, you can do that, or you can keep the money intact and let it grow over the years and access it whenever you need it for healthcare expenses. The money that goes in is tax deferred, so you do not pay income tax on the amount that you contribute that year, okay? And it grows just like a IRA or 401k, it grows tax-free. And like I said, at any point for qualified healthcare expenses, you can reimburse yourself or just pay the expenses directly from your account. For 2021, let's see. For 2021, because of the COVID and the tax law changes, you can actually use the health savings account for some over-the-counter expenses. You'll have to confirm which apply and which don't, but it's not, this year, it's not just prescription drugs and such. Keep good records. One thing you can do is if you contribute to a health savings account, let's say you contribute today, and you incur expenses this year, but you decide not to reimburse yourself. And next year you realize, oh, you know what? I really need a little bit of extra cash. You can reimburse yourself for 2021 expenses in 2022. So this, the IRS really cares about how much you contribute in a year because that's reducing your tax liability. They don't care when you reimburse yourself, as long as you don't reimburse yourself more than once for the same expense. And after age 65, the health savings account acts like a retirement account. So after you're 65, you have three different options. You can keep the savings account intact and let it continue growing, so you don't have to take anything out. You can reimburse yourself for healthcare expenses tax-free, so you won't pay tax and you'll also reimburse yourself for those expenses. Or you can access that money for any other regular expenses. Now, then you will pay income tax, kind of like an IRA, but you will not pay any penalties if you wait till you're 65. So the health savings account is it's like a triple threat, tax deferred today, tax free if you use it for healthcare expenses, and then you pay income tax after 65 for retirement expenses, but you've got the benefit of all this growth And if you never want to touch this account, you never have to touch this account. So lots of benefits, but you have to have a high deductible healthcare plan in order to contribute. Thoughts or questions? Okay. Other tax highlights, I'm trying to watch my time here. All right, stimulus package. There's been a lot of talk about the PPP and the EIDL. So you can talk to your banker or your CPA about these two plans. Charitable contributions. So in 2020, you could deduct up to $300 of charitable expenses if you do not itemize. So if you itemize your deductions, of course, there's a lot more that you can contribute and get a tax benefit depending on your income. But for those who claim a standard deduction for 2020, if you're filing single, you can, and 2021, you can deduct $300 for cash contributions. For 2021, you can also deduct $600 if you're filing jointly. So if you are charitably inclined, but do not claim an itemized deduction, you have a little bit of a benefit last year and this year that you wouldn't normally. The savers credit. So the savers credit, if you save for your retirement, put money into a qualified retirement plan, 401ks, IRAs, SEP IRAs, and if your income is below the thresholds, and the thresholds are fairly low, but 2020 was a not as profitable a year for many. So it might be that you qualify for 2020 where you normally wouldn't. You can get a credit, a tax credit for a portion of your retirement contributions. So if you contributed in 2020, you should ask your CPA about this. It's a non-refundable credit. So if you don't have a tax liability, if you're a zero tax, then you can't, get a refund, but it will bring your tax liability down if you qualify. Eligibility, you have to be 18 years of age or older, not a dependent, not a full-time college student, even if you're independent, and you have to be within those income limits. And then the amount of the credit is 50%, 20%, or 10% of the maximum allowed, depending on your filing status and your income level. All right, so a few tax highlights for the self-employed. We talked a little bit about health insurance. We talked about health expenses, but for health insurance, if you're self-employed, you can deduct your medical and dental premiums for you, your spouse, and your dependents, as long as you're not eligible to be on your spouse's plan. If your spouse is employed and you're eligible for their plan, then this deduction is not applicable to you. Continuing education. So if you have qualifying work-related education, you can deduct that off of, against your business expenses. You can also potentially qualify for the lifetime learning credit. So if you're, working towards a degree, or if you're working towards a credential within your, within the area that your professional area, this credit could reduce your taxes dollar for dollar. And there are income limits. They're a little bit more generous than the ones for the savers plan. Okay, so we're going to jump into retirement, and our time is going by really quickly. Does anybody have any questions? I'm going to try and fly through this a little bit. Okay, so
see you in the chat box.
Okay, all right, so retirement. So we've got 401ks. If you're employed, you might be eligible to contribute to an employer's 401k. These contributions are tax deductible at the beginning. I'm having a little bit of trouble. This bar is blocking my screen. You have to leave the assets in there until 59.5 in order to avoid taxes and excess fees. And any portion that was deferred from taxes is subject to income tax at withdrawal. So for a regular 401k, you will pay tax on the back end. You can invest the 401k. I'm sorry, I can't see the top here. Does it say 401k or Roth?
It says IRA.
IRA. So I'm sorry, IRA. So you can invest, so the IRA is your own personal plan. I apologize, not your 401k. You can invest that anywhere, any investment organization, Fidelity, Vanguard, Schwab, that custodies retirement accounts, you can open up an IRA there. The 2021 contribution limits are $6,000 and per person, and $7,000 if you are 50 or above, you get to put in an extra $1,000. And for a Roth, for an IRA, you have to make withdrawals. The new age is 72. So that just changed last year. Used to be 70 and a half. And if you turned 70 and a half before last January, then that old age still applies. If you are invested in a Roth IRA, similar investment options and contribution limits. You can take your contributions out without penalty before 59 and a half. So a strategy is, $6,000. If you put the maximum amount in every year, you will still pay tax. That doesn't reduce your income tax, but you can take those contributions out if you need to without penalty before age 59 and a half. I don't recommend doing that because, the point is to let these assets grow over time. If you take it out, you no longer have that tax deferred growth, right? And you can't put it back in because there's a limit as to how much you can put in every year. So, and again, the contributions are not tax deductible, but on the back end, you will not pay any tax after you've reached the age requirement. You won't pay any tax on your contributions or the growth. So benefits. 401ks are similar. So 401k and an IRA are similar, but they have different contribution limits. You can put a lot more into your 401k, and oftentimes your employer will match. And so if your employer offers that match, you should take it. That's potentially a 50% to 100% return on that contribution. And then the Roth 401k is also an option, similar income limits. And like the Roth IRA, the contributions are not deductible now, but you will not pay any tax on the back end on the growth. And with a Roth 401k, if you choose never to take any money out of it, just like an HSA, you don't have to. You can leave the money in that account for your heirs. It can be part of your estate plan. All right, SEP IRA. If you are self-employed, you can open an SEP IRA for you and your employees. It's a simpler plan than the 401k, and the contributions, the limit is 25% of your income or $58,000, the lesser of those. So there's a limit to how much you can put in there. And if you can contribute to other defined contribution plans like 401ks, whatever you put in that combines with your SEP contributions. The two together cannot exceed these limits. Okay. How much to save for retirement? I'm going to skip this. And we just have a couple minutes, don't we?
Yeah, that's fine. I mean, if people need to cut out, that's fine. We understand. But if we need to go a little longer, we can do that too.
Okay. Okay. So how much to save for retirement? I've been asked this question sort of like, I like to do individual plans for people and figure out their expenses, et cetera, and really determine how much you need personally for retirement, because it varies from person to person. Fidelity has sort of a yardstick, a rule of thumb, and they basically say that here are your milestones. At these different ages, you should have this multiplier of your income. So at age 30, let's say you're making $40,000 a year, you should have $40,000 saved for retirement by age 30. By age 60, your income's going up. Let's say you're making $80,000 a year. They're telling you that now you apply the 8, multiply by 8 against that 80,000. So 640,000 saved for retirement by this age. It's a very loose rule of thumb, right? Because it's individual to each of us. And also, this is saying how much you should have saved for your retirement. You're also, if you have rental properties, you've got, income likely coming in from your rental properties, which will supplement this. You might have other sources of income. Maybe you're working a second job, or, like you'll be working in your retirement. You might have an annuity. So there's lots of different sources of income. So this is really very much a rule of thumb. But if you are tracking your net worth, you can apply these milestones to that net worth growth goal that you're setting for yourself. Investing, so different categories of investments, different asset classes. I'm just going to go through this really quickly because I want to talk about asset allocation in a minute. So the general types of assets that you might have both in your retirement account or in a taxable account. Cash. Cash is, of course, liquid, right? So we think of, your checking savings account. If you're invested in a money market fund, those are same as cash. So the benefit of cash is that it's liquid. You can access it whenever you want. If it's in your retirement account, of course, there are penalties to accessing it, but just liquid cash in your checking or savings account, you can access it any time. And the main drawback is that you lose purchasing power over time. It's not going to earn interest that keeps up with inflation. So you want to have some cash for your emergencies, but maybe not all cash. Bonds are basically loans. So bonds are theoretically fairly stable. There are two aspects of bonds, though. You get a return because it's a loan. It should be generating income, right? The interest that's paid on that bond is income to you. It also has capital gains. So when you invest in a bond fund or directly into bonds, the value of the bond itself can go up or down, depending on what the general interest rate is. If general interest rates are going up, the value of your bond is going to come down because especially if it's a fixed rate bond, because you're fixed at a lower rate and the interest rates are going up. So someone would prefer to buy a bond with a current higher interest rate than your bond with a lower interest rate, right? So, and then the reverse happens. So bonds, while they're fairly stable, are not completely stable because they do have capital gains, that fluctuate. So stocks, equities, buying shares in a company, these are generally more volatile than bonds. And I say generally because, again, bonds can fluctuate. And then depending on the quality of the bond, that also affects how much it will fluctuate. So high quality bonds are more stable than lower quality bonds. So stocks, you're buying a share in a company. The company might pay you dividends. So that's the income portion. And then the value of the company might go up and down, which influences the value of that stock. And so it also, capital gains and losses are possible there. And real estate, which you all are very familiar with, again, also income producing. And, the capital gain potential for a property is a great thing because properties do generally tend to increase in value over time. Of course, not as liquid, right? So it's a fixed investment. One thing to do this year is to check your asset allocation. If you have retirement accounts that you're investing in or taxable accounts, and you've set an investment allocation, if you're working with someone and you're supposed to be, 70% stocks and 20% bonds and 10% cash, make sure that you're still there. And if you're not, then rebalance. Maybe you need to sell some of your stock portfolio and invest into bonds or put more into cash, or, just this is a good time to do that. And this is something to do at least once a year, maybe twice a year, but not too often. So bridging the gap. Another thing to look at is your cash emergency fund. I would say make sure you have 6 to 12 months of expenses in a cash emergency fund. So whether it's a savings account or a money market account, something that you can access. In 2020, this year, really showed the importance of that, right? It's possible tenants had difficulty paying their rent and you have a source of cash to pay your own expenses, or there might have been a job loss, or there was a lot of upheaval this year. So that cash emergency fund is very important because it allows you a place to get cash for expenses without having to put something on a credit card. or take out of your retirement account, which you want to preserve for long-term growth. Again, keep it in a cash equivalent account and be cautious about multi-purpose savings. So I have people who say to me, I have 6 months of cash and I have 6 months in a cash account, and I'm planning to buy a car in a year. Well, that's not an emergency fund if you're using it to buy a car, right? You need to keep building that so that you still have that, the body of that emergency fund intact, right? It's not a place to dip in to go on vacation. And then on the other end, we talked about the long-term retirement accounts. Also be wary of multi-purpose strategies for those retirement accounts. If your retirement account is for retirement, make sure that's what you're using it for and you're not dipping into it. You know, if April comes around and you have an IRS bill that's due and you're going to your retirement account because that's your only source of funds, not only are you paying penalties by taking money out, but you're decreasing your ability for that long-term growth. So if you have sufficient emergency fund and you're putting enough money into your retirement account, you can bridge that gap with a taxable account. So now you can open a stock trading account and put some cash in there, right, for medium-term growth. So anything, if you have enough cash, you don't have any unexpected expenses coming up in the next 5 years, you're not expecting anything, then you can start investing in a taxable account. So that is something you can access without penalty should you need to, but you want to make sure it's 5 years or longer because the stock market and the other investment markets do tend to fluctuate. So you don't want to have to sell at the wrong time. All right, so action item there. All right, quickly on insurance. Lots of different types of insurance, homeowners, renters. I'm not going to get into every single, detail of these, but I will say that a planning thing to do is to review your insurance policies. When they're up for renewal about a month before is a good time to make sure that you still have competitive premiums, that you've got the coverages you need, and your insurance specialist can help you with that. So make sure that you're reviewing them. If you don't do it every year, every 2 to 3 years at a minimum. And then estate planning. Okay, so at a minimum, you should have powers of attorney. So if something happens to you and someone needs to make healthcare decisions for you or financial decisions for you, think about who you want that to be and get that documented. Because if you find yourself in this situation, you want that person to know that they need to step in and make those decisions for you, and you want to have the paperwork properly in place so that the person you've designated that you trust can do that for you. These documents are state specific, so if you moved to North Carolina recently from somewhere else and you have these documents, have a North Carolina attorney review them to make sure that they are in line with North Carolina law.
Hey, Michelle, we have a couple questions, if you
Sure.
don't mind.
Yeah.
For an SEP, do you need a corporation or an LLC, or can you just do it as a sole proprietorship?
I believe you can do it as a sole proprietorship. And it's that flow through. So you cannot open an SEP if you're a passive investor, but if you are an active, like if you have an active business, your income and your expenses are going to determine how much you can put into the SEP. But yes, if you're self-employed, you can open it as a sole proprietor, you can open an SEP and contribute to it. So talk to your accountant about that. But yes, you can be an S Corp or an LLC or a disregarded entity, LLC with a disregarded entity, or a sole proprietor.
Okay, perfect. Yeah. And as far as the POAs, is your spouse automatically considered a POA, or is that specific paperwork you have to assign them?
That's a good question. I don't know the complete answer to that question, to be honest with you. I don't want to, I would confirm with an attorney. I don't want to give the wrong answer on that.
Sure.
But yeah.
Yep, thank you.
Yeah, you're welcome. The other thing to think about is, someone can say, I would think from the hospital point of view, like someone saying, I'm this person's spouse. versus having a piece of paper and then the identification, right? Like,
Right.
you know, this person can make these decisions for me, and your spouse can come with the paper and the identification. But yes, I don't know if that's automatic or not. The other thing to think about is most of us spend a lot of time with our spouses. So like in the event that like you and your spouse are driving somewhere and get into a car accident and you're both incapacitated, I mean, the chances of that happen. So the other thing about a POA is it says who the backup person is too. So if the person you've designated can't make these decisions for you for whatever reason, there's somebody else in line, right, to step
Gotcha.
in. So
Yeah, that makes a lot of sense. Thank you.
yeah, if you have dependents, you should have an estate plan, because this is where you declare who's going to take care of your kids or your other dependents if something should happen to you. And in this situation, if you have a spouse, that spouse is automatically the person who takes care of your, I mean, if they're your kids jointly. But again, this plan will determine, like, that's where you state what happens if both of the children's parents are not available to take care of them. When your kids become adults, when they reach 18, they should have simple paperwork in place. They should have their own powers of attorney, because adults, their parents do not automatically step in for them. So they should have their own powers of attorney. And if they have dependents at any point, they should have simple wills as well. And then your plan should be reviewed at any life stage. If you recently gotten married, have recently had kids, there's been a death in the family, you've moved, any major financial change, it should be reviewed. And at a minimum, I would say, because state laws do change from time to time, if there's a change in a law that you know of, it should be reviewed. But I would give it maybe every 5 years or so, just to be safe. All right, so now that we've talked about some action items in different areas of your financial life, let's make you accountable. What I recommend that you do is go through, all these different steps. It's a little overwhelming to do at once. So schedule it out for the year. Take these action items that you want to implement and decide when are you going to do those things. So maybe you start your net worth chart in January so that you're tracking it through the year, and you start thinking about your tax planning right now. And maybe you review your estate plan in September or something, but make a plan. And that way, when you get to that part of the year, you'll remind yourself that you need to focus on that item. Okay. And finally, reach out if you have any questions, or just, want to touch base on any of these items. And I know that we're way over time, but if you have any questions, I'm happy to stay for a little while longer. And thank you guys for having me. Appreciate it.
Absolutely. Thanks for being here. Do you guys have any questions for Michelle? Aaron says thank you. I do have one. So our company was acquired by another company, and so I have the option to do whatever I want to with my existing 401k, which is a Roth 401k. Can I leave it where it's at, or do I have to figure out what to do with it? Do I have to, roll it over into a new 401k, or can I roll it over into an IRA and then decide what I want to do with that?
So it's a new employer that you didn't change companies. The company changed.
Right.
Is that right?
That's right.
Okay. Yep. The company changed. I would talk to your human resources department about that, because I would think, well, it depends. So if they have an outsourced, like benefits, like an ADP type of company, doing all of this, a lot of times they'll give you instructions to move all that into a new plan, like the new company plan.
Okay,
sure. But it's possible that they're not doing that. So I would, if I were you, I would confirm if that's happening. Okay. And if it's not happening, I would consider moving that into a rollover IRA. Okay. And taking it out of the company. I think one thing that I find that happens to people is over time, as they move jobs or their jobs change or whatever, they've got all these lingering 401ks from various old employers that are just out there. And then after time, you kind of lose track of them, so with each employer change, I would absolutely either, roll over that into a new IRA, like a rollover IRA, right? And then
Right.
if it happens again in the future, you have a rollover IRA already established that you can move that next plan into, so that you have it in a place where it is.
Sure.
I definitely recommend doing that unless the company has moved it into their new plan for you, which is
Gotcha.
entirely possible. If they do that, though, they'd have to reach out to you so that you can complete the paperwork on how you want it invested and all that kind of stuff. So
Right.
there should
Yeah,
be some communication.
I think I have the option either to roll it over to Vanguard, which is who the new company's with,
Hmm.
or get a check, which I know I don't want to do that because I don't want to pay the
Hmm.
penalties or the taxes.
Right.
Or I've already paid the taxes, but the penalties anyways.
Yeah.
Um, but yes, okay. So that's good option. Thank you.
Yeah. Yeah. Good.
All right. I don't see anything else. Lots of thank yous.
Thank you for having me.
Absolutely.
I appreciate
Well,
the opportunity to be with you. Go ahead.
yeah, absolutely. Yeah, so if you guys need anything, feel free to reach out to Vishali at the information on the screen. And other than that, we will see you at the main monthly meeting, which is not this week, but next Thursday night. So thanks, everybody. Thanks, Vishali.
Thank you. Bye-bye.
Bye-bye.